Good day, future CPAs. Welcome to another video in which we strive to be our greatest aspirations. In this presentation, we will cover the Chapter 9 of Zeus Vernon B. Melan's Intermediate Accounting 3, 2021 edition. It is primarily concerned with interim financial reporting, but in this video, we'll go over it in a greater detail. Before anything else, here are the main objectives of this presentation. Now, I'll begin by introducing the applicable accounting standard in interim financial reporting, which is the PAS 34 or the Philippine Accounting Standard 34. This is the accounting standard that prescribes the minimum content for an interim financial report. It also prescribes the principles for recognition and measurement in complete and condensed financial statements for an interim period. So later, didiscuss natin kung ano ba ang minimum content ng interim financial report at kung ano-ano nga ba ang nilalaman ng complete at condensed financial statements para sa interim period. The PAS 34 also does not mandate which entities should produce interim financial reports. Meaning, ang PAS 34 ay ina-apply lamang if an entity chooses to do so, or kung nire-require ang isang entity ng government or ng other institution na mag-publish ng interim financial report na nagko-comply sa mga PFRS. And lastly, under PAS 34, publicly listed entities are encouraged to provide interim financial reports at least as of the end of the first half of their fiscal year, and to make them available no later than 60 days after the end of the interim period. And those entities that are registered under Securities and Exchange Commission and Philippine Stock Exchange are also required to file a quarterly interim financial reports within 45 days after the end of first 3 quarters. Remember na ang purpose kung bakit nare-require ang mga publicly listed entities na mag-file ng interim financial report ay para mapanatiling updated ang mga shareholders or investors ng isang entity. Its goal is to also keep analysts in regular communication with corporate management and to alert the public to material changes dahil ang mga publicly listed companies ay also publicly accountable. Moving on to the next slide, the key definitions of PAS 34 are provided. This will be mentioned several times in this lecture, so mahalaga nang familiarize kayo sa mga terms na to.
Definition of terms. Interim reporting pertains to the preparation and presentation of interim financial report for an interim period. Interim period. A financial reporting period shorter than a full financial year. Interim financial report means a financial report containing either a complete set of financial statements past 1 or a set of condensed financial statements past 34 for an interim period.
As I have said a while ago, we're going to discuss the complete and condensed set of financial statements. So, ano nga ba ang complete set of financial statements at set of condensed financial statements? Ang complete set of financial statements is made up of 5 components: the statement of financial position, statement of comprehensive income, statement of changes in equity, statement of cash flows, and notes to financial statements. Meanwhile, ang set of condensed financial statements naman is the minimum content of an interim financial report. It comprises a condensed statement of financial position, a condensed statement of comprehensive income, or a condensed statement of comprehensive income and condensed income statement, a condensed statement of changes in equity, a condensed statement of cash flows, and selected explanatory notes. The entity applies PAS 1 if it opts to provide a complete set of financial statements, and PAS 34 for a condensed set of financial statements. Note that if the interim report contains a complete set of financial statements, the financial statements should be in full compliance with IFRSs. If the financial statements are condensed, they should include all of the headings and subtotals from the most recent annual financial statements, as well as the PAS 34 explanatory notes. For the disclosure of significant events and transactions, a reporting entity only includes explanatory notes that are relevant to understanding the current interim period. The interim financial statements do not repeat the disclosures seen in the most recent annual financial statements. Ang mga information na nasa notes ay normally pinapresent on a financial year-to-date basis. So, PAS 34 provides a list of examples that, if material, it would require disclosures. In addition to all of this, the following are also disclosed in interim financial reporting. Now let's move on to look at the periods for which interim financial statements are presented. The periods that must be included in the financial statements are described in PAS 34. These are contradictory and distinct from annual financial statements in some ways. The time periods that will be given are the same for both complete and condensed financial statements. Period presented for semi-annual interim financial reporting are
And statement of financial position. Current, June 30, 20x9. Comparative, December 31, 20x8. Statement of comprehensive income and, where applicable, separate income statement 6 months ended current June 30, 20x9, comparative June 30, 20x8. Statement of changes in equity 6 months ended, current June 30, 20x9, comparative June 30, 20x8. Statement of cash flow 6 months ended, June 30, 20x9, comparative June 30, 20x8.
For quarterly reporting,
Statement of financial position, current September 30, 20x9, comparative December 31, 20x8. Statement of comprehensive income and where applicable, separate income statement. 9 months ended, 3 months ended. Current September 30, 20x9 for the 9 months ended and September 30, 20x9 for the 3 months ended. September 30, 20x8 for the comparative. Statement of changes in equity, 9 months ended. Current September 30, 20x9 and the comparative is September 30, 20x8. Statement of cash flows, 9 months ended. Current is September 30, 20x9 and the comparative is September 30, 20x8.
Materiality. Materiality should be assessed based on interim period financial information, not the full annual reporting period. PAS 34 recognizes that interim measurements may rely on estimates to a greater extent than measurements of annual financial data. The overriding goal is ma-ensure na naka-include sa interim financial report lahat ng information na makatutulong upang masigit na maintindihan ang financial position at performance ng entity during interim period. And there are two views on interim financial reporting. Number 1 is integral view. Under the integral view, annual operating expenses are estimated and allocated to the interim periods based on forecasted revenues or sales volume. In other words, costs incurred which clearly benefit the entire year are allocated to the interim periods benefited. For the number 2 is the independent view. Independent view is that each interim period is considered a discrete or separate accounting period with status equal to fiscal year. Thus, no estimations or allocations are made for interim purposes unless such estimations or allocations are allowed for annual reporting. PAS 34 on interim financial reporting does not mention about the two views. Essentially, the standard adopts a mix of integral and independent views. PAS 34 provides general principles for recognition and measurement. An entity shall apply the same accounting policies in the interim financial statements as are applied in the annual financial statements. In example, losses are recognized immediately in the interim period in which they arise. Cost na hindi qualify as an asset in an interim period is not deferred either to wait if it qualifies in the next period or to smooth earnings over the interim periods within a financial year. Income tax expense in interim period are based on the best estimate of the weighted average annual income tax rate expected for the full financial year. The measurements for interim reporting purposes shall be made on a year-to-date basis so that the frequency of reporting, whether annual, semi-annual, or quarterly, shall not affect the measurement of the annual results. Revenues received seasonal, cyclical, or occasional revenue shall not be anticipated or deferred as of an interim date if anticipation or deferral would not be appropriate at the end of the entity's reporting period. Uneven costs that are incurred unevenly during an entity's financial year shall be anticipated or deferred for interim purposes only if it is also appropriate to anticipate or defer that type of cost at the end of the financial year. If there are changes in accounting policies, the interim financial report is required to include a description of the nature and effect of the change. And their statement of previously reported interim periods, PAS 8 states that retrospective application of a new accounting policy is impracticable when an entity cannot apply it after making every reasonable effort to do so.
PAS 34 provides a series of comprehensive examples that demonstrate how the recognition and measurement principles discussed in the preceding slides might be applied. First, in an interim period, under PAS 38, intangible asset, ang mga research and development costs ay nire-recognize as expense. However, ang development cost naman is nakakapitalize lang kapag na-meet nito yung recognition criteria under PAS 38. Also, in an interim statement of financial position, deferring costs as asset in the belief that the recognition criteria will be met later in the financial year is not justifiable. Second, inventories are measured at the lower of cost or net realizable value. The net realizable value of inventories is determined by reference to selling prices and related costs. An entity will reverse a write-down to net realizable value in a subsequent reporting period. Estimates are frequently used by entities to measure inventories at interim dates instead of at the end of yearly reporting periods. Last to this principle is the foreign currency translation gains and losses. Under PAS 21, ang translation adjustments ay nire-recognize as income or expense in the period in which they arise. If a foreign currency translation adjustment is expected to reverse before the end of the year, entities do not defer it at an interim date. For the second principle, we have dividend income and government grants under it. Dividends or government grants received during the financial year are not anticipated or deferred in the interim financial statements unless it is appropriate to do so at year-end. An entity, for example, na nag-expect na makaka-receive ng dividend sa second half ng financial year, so in this case, it will not recognize partial revenue for this dividend in its first half year in interim financial statements. Such revenue is recognized only when it occurs. Third principle, costs incurred unevenly during the financial year. The several important points here are the payroll taxes, depreciation and amortization, and the income tax expense. First, if employer payroll taxes or contributions to government-sponsored insurance funds are assessed on an annual basis, the employer's related expense is recognized in interim periods using an estimated average annual effective payroll tax or contribution rate, even though a large portion of the payments may be made early in the financial year. Second, depreciation and amortization for an interim period is based only on assets owned during that interim period. It does not take into account asset acquisitions or disposals planned for later in the financial year. Third, interim income tax expenses are therefore accrued using the tax rate that would be applicable to expected total annual earnings. The estimated average annual income tax rate is required to be re-estimated on a year-to-date basis. And lastly, the preparation of both annual and interim financial statements usually requires the use of estimates. However, the preparation of interim financial reports generally requires greater use of estimates than annual financial reports. Here are a few important points to consider. For inventories, full stock taking and valuation procedures may not be required for inventories at interim dates, although it may be done at financial year end. It may be sufficient to make estimates at interim dates based on sales margins. Second, for income taxes, entities may calculate income tax expense and deferred income tax liability at annual dates by applying the tax rates for each individual jurisdiction to measures of income for each jurisdiction. It is acknowledged that while that degree of precision is also desirable at interim reporting dates, it may not be achievable in all cases. A weighted average of rates across jurisdictions or across categories of income is used if it represents a reasonable approximation of the effect of using more specific rates. Lastly, for valuation and fair value accounting, PAS 16 or Property Plant and Equipment allows an entity to choose as its accounting policy the revaluation model whereby items of property, plant, and equipment are revalued to fair value. Similarly, PAS 40 Investment Property requires an entity to determine the fair value of investment property. For those measurements, an entity may rely on professionally qualified valuers at annual reporting dates. This may not be necessary at interim reporting dates.
For the illustration 1, recognition and measurement in interim periods. ABC Corporation reports profit before tax of 1 million in its second quarter interim financial statements before consideration for the following. So, ang requirement ay compute for the adjusted profit before tax. For the solution, we have the adjusted profit before tax na 1 million. Less write-down of inventory na 20,000 from 100,000 carrying amount less net realizable value na 80,000. Impairment of asset na 40,000 ay ililess din natin sa unadjusted profit before tax. Nakuha yung impairment of asset na 40,000 through deducting the carrying amount to its recoverable amount. Unrealized gain na 5,000, also less din natin ang depreciation na 90,000 from 360,000 multiplied by 1 divided by 4. At ganoon din sa employee benefits na 240,000 multiplied by 1 divided by 4. Para makuha natin yung 60,000 and we will come up with the adjusted profit before tax na 795,000. Let's proceed with the illustration 2. Costs incurred unevenly. ABC Corporation profit before tax for the first and second quarters of 20X1 were 880,000 and 920,000 before any necessary adjustment for the items listed below. So, ang requirement naman dito ay ang adjusted profit before tax para sa first and second quarters. Solution. First ay ang adjusted profit before tax ng first and second quarter na 880,000 at 920,000. Total unfavorable variance amounted 24,000 in the first quarter. Advertisement cost na 90,000 multiplied by 1 divided by 3. And we can get the amount of 30,000 for the second quarter. Unrealized loss or gain on investment, we have 100,000 in the first quarter and 120,000 in the second quarter. Research and development expense na 10,000 in the first quarter at 12,000 sa second quarter. Foreign exchange loss or gain na 10,000 at 15,000 para sa dalawang quarter. Lastly ay ang impairment loss na 8,000 from deducting the 200,000 to 192,000. And we will come up with the answer or the adjusted profit before tax amounting to 728,000 for the first quarter and 1,013,000 for the second quarter. Notes: Number 1. Deferral of variance that are expected to be absorbed by year-end is not appropriate. 2. The advertisement cost will be incurred over the remainder of the years starting April. Thus, the advertisement costs are allocated over the second, third, and fourth quarters of 20X1. So, yung advertising cost na 90,000 kanina ay multiply by 1 quarter over 3 quarters or 30,000 per quarter. 3. Unrealized loss and gain on the held for trading securities are computed as follows. Carrying amount before end of quarter adjustment 200,000 first quarter and 100,000 second quarter. Fair value as of end quarter na 100,000 at 200,000 equals to unrealized gain or loss for the quarter na 100,000 sa first quarter at 120,000 sa second quarter. The recovery exceeded previous write-down by 20,000, 100,000 previous write-down plus 20,000 excess. 4. Research and development costs that were initially recognized as expense shall not be capitalized later on. Reinstatement of previously recognized expense is prohibited. 5. The foreign exchange gain or loss on the foreign currency denominated receivable is computed as follows. Carrying amount before end of quarter adjustments, $1,000 multiplied by 40 pesos exchange rate is equals to 40,000 for the first quarter. $1,000 multiplied by 30 pesos exchange rate is equals to 30,000 for the second quarter. Translated at current exchange rate as of end of quarter, we have 30,000 in the first quarter and 45,000 in the second quarter. So the foreign exchange loss or gain were 10,000 and 15,000. Last illustration. Measurement of interim income tax expense. ABC Corporation expect to earn 10,000 pre-tax profit in each of the first and second quarters of the year and 15,000 pre-tax profit in each of the last 2 quarters. The tax rate as of the beginning of the year is 30%. However, following a new enacted tax legislation, the tax rate will be increased to 40%, which shall take effect beginning on the last quarters of the year. Actual earnings match expectations. Requirement: compute for A. Weighted average annual income tax rate and B. Income tax expense recognized in quarterly interim financial statements. Solution for requirement A is computed as follows. To get the income tax expense for the first 3 quarters, add the total profit for the first 3 quarters. 10,000 plus 10,000 plus 15,000 is equals to 35,000. Multiply by tax rate applicable for the first 3 quarters na 30%. And the answer is 10,500. To get the income tax expense for the last quarter, profit for the last quarter na 15,000 ay multiply by tax rate applicable for the last quarter na 40% equals to 6,000. Lastly, for the weighted average annual income tax rate, total income tax expense for the year na 16,500 divide by total profit for the year na 50,000 equals to 33%. Solution for requirement B. Quarterly income tax expense are computed as follows. Yung pre-tax profit ng first, second, third, fourth quarter at annual ay mamultiply by 33% na average tax rate na nakuha kanina. So the income tax expense for the first and second quarter are 3,300, for the third and fourth quarter are 4,950 and 16,500 for the annual. The last 2 slides were the example of interim consolidated statement of financial position.
And so that is all for interim financial reporting. I hope you're able to pick a lesson or two. With that, I'm going to end this presentation with a very timely reminder for everyone that even if it gets tough, keep moving forward. So good luck future CPAs, all the best in your studies.